All right, today we're going to break down a framework that, well, it might just change how you see the entire economy, not to mention your own money. So let's dive right in.
You ever have that feeling? You're working hard, you're trying to save, but it just feels like the goalposts keep moving further and further away. It's like you're running on a treadmill that someone keeps speeding up. Well, what if I told you that feeling isn't just in your head? According to this framework, it's actually part of the system's design.
So, let's start with a number. 11%. According to the Everything Code, this is your new magic number. It's the return you need to make on your investments every single year just to keep your head above water, just to maintain your purchasing power. Anything less than that, and you're actually getting poor over time. So the big question is, how on earth did we get here?
Well, the answer isn't really about this political party or that policy decision. Nope, it's something much deeper, a force that's been building for decades. And it all starts with a simple fact: demographics. It's a chain reaction, and it's pretty straightforward. For decades now, birth rates in the developed world have been falling. That means, eventually, you get fewer workers. Fewer workers means the economy just can't grow as fast. We're talking maybe 2% a year. But governments have massive obligations, right? So to plug that gap between slow growth and their spending, they're left with one main tool: taking on more and more debt.
And you can see it right here. It's like a perfect mirror image. As the labor force shrinks, government debt just balloons to fill that economic hole. You have to understand, this isn't a mistake or a bug in the system. It's now a core feature of how it operates.
And the thing is, this isn't some wild guess. We can predict the size of the workforce years, even decades into the future because we already know the birth rates from the past. That trend is down, which means the debt trend really only has one way to go: up. This predictable cycle, this is the foundation of what this framework calls the Everything Code.
Okay, so if governments are basically forced to keep piling on more and more debt, how do they actually manage it all? I mean, how do you pay the interest on that debt when your economy is only growing at 2%? Well, the short answer is you don't. You create a whole new system to deal with it.
They manage it with this thing called global liquidity. It's a fancy term, but all it really means is money created out of thin air by central banks and the banking system. And its main job? To finance all that government debt. It's a constant, steady drip of new money being pumped into the global financial system.
Now, there's a huge consequence to all this money printing. It's called currency debasement. Your dollars, your euros, your yen, they're being devalued at a steady rate of about 8% a year. And this isn't the inflation you see at the store. This is separate. It's like a hidden, invisible tax on every dollar you save. So you take that 8%, you add the 3% or so of regular inflation, and there you have it. That's our 11% hurdle rate.
And you gotta understand, this isn't just some small factor in the background. According to the source of this framework, this constant flow of liquidity has become the single most dominant force driving the price of, well, everything. Everything else is pretty much just noise.
Just how dominant is it? Get this. The analysis shows that the flow of global liquidity can explain a staggering 96% of the price movements in the NASDAQ. 96%. That means all the other stuff, company earnings, geopolitics, big news events, all of that accounts for just 4%. It's literally a rising tide of money lifting a very, very specific group of boats.
So, if you've got this massive wave of new money flowing into financial assets, but it's not really flowing into the real economy where people work and live, what does that do to society? Well, it creates this giant funnel and a massive disconnect.
And this, right here, is why it feels like you can't get ahead. Your paycheck, it's tied to that slow 2% growth of the real economy. But the price of the things you want to own, like stocks and houses, their prices are riding that 8 to 11% wave of new liquidity. That's the disconnect. Asset prices are inflating 5 times faster than your salary is. So in this new world, how do you actually beat that 11% hurdle rate? Well, the data is pretty clear. Your traditional safe assets like bonds, they're failing. Even real estate is falling short. The broad stock market, the S&P 500, it's basically just treading water, letting you break even. This framework shows that there are really only 2 asset classes consistently winning this race. According to this entire framework, it all boils down to this. Only technology stocks and crypto have been generating returns that consistently and significantly outpace that rate of currency debasement. In this liquidity-driven ocean, they are pretty much the only 2 life rafts.
The source material has this incredible analogy for it. It calls this phenomenon a supermassive black hole.
all the capital, all the value, is being irresistibly pulled out of those underperforming assets and just funneled into these two sectors. Why? Because it's the only place where wealth can actually be preserved and grown. Okay, so we get the past, we get the present, but what does this framework say about what's coming next? Well, it suggests the game we're in right now is about to get longer and maybe a whole lot bigger. You see, historically, this whole liquidity cycle is run in these pretty predictable 4-year waves. But a little while ago, governments did something clever. They extended the maturity of their debt. They kicked the can down the road. And in doing so, they stretched this cycle out to over 5 years. And what does that mean for us? It means the current bull market is likely to last a lot longer than most people think, potentially well into 2026. And what's going to fuel this longer cycle? This number right here, $9 trillion. That's how much government debt needs to be rolled over in just the next 12 months. And guess how they're going to do it? The only way they know how, with another massive wave of liquidity, probably the biggest one we've ever seen.
So what's the big takeaway from all of this? Look, it's a controversial idea for sure, but it's that the old rules of investing, they just don't apply anymore. If only 2 asset classes are actually beating the system, the logical conclusion is that traditional diversification is a losing strategy. The new path forward, according to this code, is hyper-concentration in the assets that actually work.
And that leaves us with one final, absolutely explosive question to think about. Right now, we are witnessing the single fastest adoption of a new technology, crypto, in all of human history. And at the exact same time, we're on the verge of the largest wave of global liquidity ever created. So, what happens when those two unprecedented forces collide? That, my friends, is the multi-trillion-dollar question for your financial future.